Welcome everyone. Welcome to this episode of Market Trap. I have with me Mr. Pankaj Pandey, and as we speak, of course, geopolitical tensions are high, and of course, the markets are jittery right now because of it. Pankaj sir, what is the outlook? What is happening right now?
Hi, good evening, Vishu. Yes, this has been very eventful week for the markets because of number of factors. One, markets have been jittery because of the Indo-Pak tension. Then overall, there are some positives as well. So, for example, India, UK FTA has been sort of signed. Even the broader details of US UK deals have been sort of come out. And then obviously there has been some decline in the crude oil prices structurally because the entire OPEC is not really looking to shore up or cut production and to shore up the prices. But I think the biggest news has been the Indo-Pak tension, and as a result of that, we have seen markets coming down by 1.4 odd percent to about 24,000 kind of a levels. We've seen rupee tumbling sharply to about 85.58. And I think sectorally, there's some sectors did well. So, for example, auto did well, but a lot of sectors sort of have been under pressure, be it PSU banks or real estate. Our sense is that this tension between India and Pakistan is going to persist for some period of time, and which is why we've seen VIX inching up. Then our the range I would put for the market for next week is a bit higher, so 24,500 on a higher side and 23,200 on a lower side. But just to sort of highlight is that whenever we have seen any kind of a major instances of escalation that because of armed conflict in India, especially with respect to Pakistan, most of the occasions the markets have bottomed out around the anxiety levels and eventually settled higher over the next 2 3 months. And which is why we see this as an opportunity. So, in case of the market corrects or we get a knee-jerk kind of a reaction in the market, I think that will be an opportunity to sort of build again quality portfolio. If someone has missed the previous rally from say 21,700 kind of a levels. So yes, things are going to remain jittery for the markets for some period of time till the time de-escalation does not happen. And de-escalation, once that happens, will open the door for next leg of up move in the market.
Absolutely. So you mentioned FIs have continued to pour in money. Could you give us a few more details on it?
So yes, FIs have turned positive in a segment like say index future after say October 2024. And this is a sort of a positive news for us. I think even in terms of flows also, if you look at from mid of April, the inflows have been about 50,000 odd crores. In this month of May, again for 5 trading sessions, we have seen inflows of nearly 12,000 odd crores. Our sense is that some of these flows are associated with the ETF flows and is likely to be there till the mid of this month. But what it has done is that it has muted the overall volatility in the market. But despite the fact we have seen the VIX going up to about 22% kind of a levels. Usual levels are about 14 odd percent. Now, this clearly, the rise in VIX clearly means that people are buying protection for their portfolios through index options for any eventuality. And till the time VIX does not cool off to levels like 17, I think one should be a bit cautious on the market. I think once that VIX cools off, that is where we would expect a market to sort of resume its uptrend. And I think since FIs have been positive on markets and positive on index heavyweights, say in the banking sector or in the oil and gas sector, say Reliance, which is why Nifty is down only about 1.4 odd percent compared to a 3% kind of a decline you see in the broader markets. So I think FPI flows have been definitely helping Nifty to sort of navigate the overall volatility better.
Right. Right, sir. US Fed also had its meeting. Any details there? Anything to worth noticing there?
So largely, Vishu, it was a sort of a non-event. So while Trump has been asking for rate cuts, what the Fed is clearly highlighting is that if the large increase in tariff is sustained, it is likely to sort of lead to higher inflation, slow down an economic growth rate, and also a rise in the unemployment levels. So which is why they categorically said that they're not in a hurry to sort of cut rates. and they would want more clarity to sort of emerge before they make any adjustments. So there is no premature rate cutting is what they have sort of highlighted, and which is why it gives us a perspective that even for the next policy meeting in the June, you are not going to see any action happening because all these events will take some time to sort of pan out. So from that perspective, largely anonymous.
Right, right. And coming to the big one this week, which was the India UK deal which has happened. Uh, what do you see in this deal, sir?
So I see a lot of positives in this deal, Vishu. I think the biggest positive is for a sector like textile because a market like UK or UK in general overall imports about 23 odd billion dollars worth of textile and related products. And India's share is only about 7 odd percent. Even a smaller country like Bangladesh has got 17% kind of a share, and China is somewhere about 25%. And in apparels, again, our share is only 5%, whereas Bangladesh is 14% and China is about 21, 22 odd percent. So I'll not be surprised if the share of some of these or the Indian share sort of gets doubled over a period of time. Because what happens that India pays about 8 to 12% kind of a duty, whereas players like Bangladesh and Vietnam, they don't pay any tariff for whatever they export to US. So this tariff reduction is definitely positive for us because one, I think on the labor cost side, we are pretty competitive. The other aspect is that we have a fairly good amount of high domestic cotton supply, so which again is a sort of a natural advantage, and which is why we are looking more constructive at companies like say Gokuldas Exports, KPR Mills, SP Apparels, Indocount. Indocount is one of the biggest bedsheet providers to US and now probably going forward in UK also, or Wellspun Living. So I think these are the companies which will benefit. Now this is with respect to the textile sector. Even a smaller sector like say gems and jewelry. Now in India, when you sort of export gems or jewelry, the VAT in UK is about 20 odd percent. But in case of gems, the custom duty is 0%. But in case of jewelry, it's about 2.5%. So all that has been brought down to nil. So definitely positive for that. Even for a sector like FMCG, I think overall sense is that a lot of ready-to-eat categories can find their way into the UK market. So you could have companies like Tata Consumer or ITC sort of benefiting. Footwear also is there, but we are not a major exporter up till now. But I'll not be surprised if some of these companies, say Bata, Metro, or Relaxo, explore opportunities in the US, in the UK market. Now, liquor is one sector where the impact is considered to be negative, but our sense is that it's not that negative the way it has been made out to be. So, from a duty perspective, we are looking to cut rates from say 150% to about 40% over a period of time. Now, when we sort of import, luxury scotch is typically is a very small market for us. And in case if we are importing scotch in bulk quantity, then it is sort of blended with other liquor brands. So it is going to help existing players there. And I think our also sense is that a lot of these foreign players might tie up with the domestic players going forward to offer their premium scotch. So from that perspective, I really do not see this negative. But yes, the overall reaction has been muted. Auto, we have already seen Tata Motors being the biggest beneficiary because the bilateral trade in the EV side is expected to go up. So UK is going to export us high-end or high-value EVs, whereas we'll be exporting the low or the mid-range EVs. So definitely positive for Tata Motors because they are coming up with a new platform than for other players like even M&M also. And I think what it also does is to Tata Motors is again they can import some of the ICEs also at lower rates and probably look to expand their market, which is not going to impact the listed companies, but probably to genuine manufacturers. So I think it is positive for autos and Tata Motors in particular. IT is another sector. So I think one of the biggest pain point for IT sector has been that whenever a worker goes in the UK, they need to necessarily contribute to the social security fund for an initial period of 3 years. And when they come back, the benefit does not accrue. So the employer used to sort of contribute. So now with this, you'll see far more freer movement of labor. companies that could benefit is again Mastech, 60% of the mix of their revenues coming from there, or either Infosys, HCLTech, First Source or Coforge. So some of these companies could benefit because they have 25 to 30% of their revenue mix coming from that particular region. So obviously, it is beneficial for IT as well. So from that perspective, I see good positive for coming out from the UK, UK India FTA deal.
Right, sir. So getting to the results that were announced this week, maybe let's start with Larsen and Toubro.
L&T, Vishu came out with good set of numbers. We've seen stock also reacting positively in a market when most of the things were down. So one, I think on the order inflows, about 24% kind of a growth to nearly 90,000 crore worth of orders. 70% of those orders have come from international side and rest coming from the domestic side. Revenue growth has been pretty good at about 11 odd percent. Margins have gone up to 11 odd percent. PAT growth is about 25%. Now, the outlook is also sort of positive because what the company is saying is that the order prospects have gone up to 19 lakh crores. It was about 12 lakh crores in FY25, and it has gone up in infra and energy projects and high-tech manufacturing in a number of other places. The working capital requirement has sort of come down. The ROEs have gone up to 16.3 odd percent. And mind you, L&T has the aspiration to reach 18% kind of ROEs going forward. So from that perspective, most of the things have come out very positive. A company is guiding for a very modest order inflow growth of about 10 odd percent. But our sense is that they'll be able to grow faster. So revenue growth for us, or according to us, is somewhere about 15 odd percent. Profit could be even more higher because we expect margin expansion to happen. And mind you, it still has a number of triggers, like, say, for example, break even of Hyderabad Metro, or margin improvement. Plus, they are generating free cash flows of nearly 18,000 odd crores. So dividend or buyback, again, depends on how things sort of pan out. So they're sitting on good amount of cash. So any kind of a utilization of that will lead to better ROEs. So overall, we're positive on L&T, but our target price have been cut because the technology business, which contributes about 35 to 40% from a valuation perspective, I think FY26 is expected to be a washout year. So net minus IT, L&T, pretty good set of numbers.
Right, sir. I think Indian Hotels also came out with its result, and while the results were good, the stock did take a beating. What happened there?
So, Vishu, if I look at the broader consumption, so Indian Hotels, yes, Indian Hotels have done very well in the past few years. This stock has gone 4x, 5x in the last few years. Now, number-wise, there's nothing to complain. Revenues have gone up by 27%. Margins have expanded by 230 odd bips. Occupancy is good at about 80 odd percent. ARRs have gone up by 15%. Management is citing even Q1 to be on the similar lines or a similar growth. Largely also because last year was a low base, also because of election plus extreme heat. But in general, hotel as a segment is expected to do well because your demand is growing at 6-7 odd percent, supply is going at only 2-3 odd percent. So our sense is that they could easily be growing at high teens of 18-19 odd percent next 2 years. EBITDA margins are pretty healthy at 36% and profit growth of 24%. Now, why this stock sort of reacted is that whenever you see this overall tensions, the sense is that the travel demand is expected to sort of take a hit, and which is where we have seen the stock sort of coming down. And so with that in perspective, we feel that 15-17% kind of a decline in the stock from the highs is a sort of a good opportunity, and with a target price which we have put at 950. So it's a good buy at current levels.
Right, sir. What about other consumption stocks? We also had Titan Company and Asian Paints coming out this week.
So Titan numbers, usually sales number, they usually disclose. So there is no element of surprise there. So Titan, I think one thing is clear that they have announced the new MD who will be taking charge from next year. Most of their businesses did well. So overall growth has been about 24%. Again, so standalone jewelry business grew by 25%. Carrot Lane grew by 23%, 20% growth in watches and wearable segment. See, the positive surprise for Titan was market was expecting, in fact, we were expecting a margin to be 10.5 to 11 odd percent. The margin came higher at about 11.9 odd percent. And largely because of the fear that since the gold prices have gone up, probably there'll be impact on the margin. So that hasn't really sort of panned out. In fact, the company also guided that this year you'll have more number of weddings. So overall sense is that the growth is expected to be again strong at 15, 20 odd percent, and margin again could be in the range of 11 to 11.5%. And I think this is one of the few companies on the consumption side which is easily talking of double-digit kind of a growth, and which is why I think any kind of a decline should be used as an opportunity to buy. Although even at current levels it can be bought. But I can't really say the same thing for Asian Paints. I think this company has been disappointing. Last quarter, volume growth was 1.6%. This quarter, volume growth is 1.8 odd percent. We were looking at 4 to 5% kind of a volume growth. In fact, the margins also declined both quarter and quarter YOY about 200 bips. While they are saying that you'll see high single digit kind of a growth probably in the second half because ahead of the festive season, people undertake painting activities. But I think overall sense is that the competition is impacting their volume growth plus margins. Customers are sort of down trading. I think over the next 2 years, earnings are going to remain muted, probably mid-single digit kind of, and which is why while we have seen good amount of price decline, but I would suggest avoiding this stock for some period of time till the time the sector regains that historical growth rate of 10 to 12 odd percent. Till that time, I think the stock should not be touched.
Right, sir. What about banks, sir? We had three banks coming up with results this week. Bank of Baroda, we had State Bank of India, and Kotak Mahindra Bank.
So yes, when I look at banks, so I'll start with Bank of Baroda. Now, Bank of Baroda came out with one of the worst set of numbers, and in fact, this is the reason why we had seen a 10% kind of a decline in the prices. And in fact, as a result of this, a lot of other PSU banks also were under pressure. Now, the challenge is that the bank witnessed a decline of 8% in margins in this particular quarter. And last quarter also, they had a similar kind of a decline. And so this kind of a decline we have not really seen for PSU banks. So, and while the growth rate was good at about, I think, 12 odd percent, asset quality was also sort of okay. But I think the sense was that management really did not give a very clear picture in terms of why the margins are down. And which is where I think the bigger worry is sort of emanating from. And our sense is that you will see margin pressure continuing in Q1 FY26 also. And any chances of recovery will happen in the second half of FY26. And mind you, banks, again, the sense is that the rate cut and expectations are sort of going up, given the fact that crude oil prices are softer. You'll have better monsoon. So again, food inflation is expected to be softer. So from that perspective, probably the earnings are going to be under pressure for banks. So other income is what is going to sort of help banks in terms of delivering better profit. Otherwise, core margins are expected to be under pressure, and Bob clearly disappointed. So I think till the time it does not emerge, we've been liking Bank of Baroda for quite some time, but I think at this point of time, it should not be touched. Compared to that, SBI witnessed a margin decline of only 3 odd bips. While in SBI, the challenge was that the growth is lower than 14 to 16%, what the management said. So they delivered a growth of 12 odd percent. But margin decline for them was lesser. And our sense is that for them, the margin decline is going to be the least. Because for SBI, about 70% of the book is based on MCLR. So basically, if the cost of funds comes down, that is when they need to sort of bring down the rates. Whereas for a lot of other banks, it is repo-linked or external benchmarking. So from that perspective, SBI is one of the few banks which is expected to witness least amount of margin pressure. And which is why I think SBI provides good amount of comfort because they can maintain their ROAs at about 1% and IMs at 3 odd percent. So within PSUs, I think I'll strike down Bob and prefer SBI. Now, Coming to Kotak, Kotak again, a weak set of numbers, but overall the growth or the asset quality has been sort of maintained. So business growth overall was 13.5%. This is despite the fact that they have acquired the portfolio Standard Chartered. For them, there were certain positives. So, for example, NIMs have improved sequentially because they undertook savings rate cut. Credit cost also sort of moderated, so no challenges on the asset quality side. In fact, only the MFI segment remains elevated for them. And good part is that they are talking of good growth of 1.5 to 2 times of nominal GDP going forward. So growth front, they are looking to sort of do well. So which is where ROEs are expected to be maintained at 2.2. And since the stock has rallied, so any kind of a weakness is an opportunity to buy Kotak Bank. So Kotak Bank, relatively better set of numbers or better outlook, I would say.
Absolutely. Well, that was it for this week. Thank you so much for lending your insights, Pankaj sir, and thank you so much everyone for watching.
Thank you so much.
Investment in securities market are subject to market risk. Read all the related documents carefully before investing.